Hello, I'm Peter Wallison, a senior fellow at the American Enterprise Institute in Washington, D.C. I've also spent some time in government serving as the General Counsel of the Treasury and White House Counsel in the Reagan administration. In this Center for Freedom and Prosperity video, I'd like to talk with you about the serious problems that currently face this country. The economy is sinking fast. Unemployment is rising. The banking sector is in terrible shape, and consumer confidence has fallen to all-time lows. The politicians in Washington say this mess is the result of unchecked capitalism and deregulation. But that can't be right. Banks are the most heavily regulated institutions in our economy, and they're in the most trouble. By blaming free markets, the politicians are hoping to distract us from paying attention to the real culprit, government policy mistakes. Today we're going to examine the negative effect of intervention in the housing market, largely through two government-created entities called Fannie Mae and Freddie Mac. These two crony capitalism companies were chartered by Congress to buy, hold, and guarantee mortgages. They were given special privileges not available to private sector companies, including an implicit government guarantee that gave them access to money at very low rates. But the special favors came with strings attached. The politicians also wanted Fannie and Freddie to somehow make housing affordable for people who couldn't otherwise afford to buy homes. And these requirements were dramatically expanded beginning in the 1990s. The result of all this government intervention was that Fannie and Freddie pumped more than $1.6 trillion into mortgages with low or no down payments, mortgages for people with blemished credit, and mortgages for people who would not allow verification that they had jobs or incomes. All that government-backed money created a frenzy for what are called subprime mortgages and other weak or junk loans. This massive government interference in private markets helped create a housing bubble. But we've had those before, and they did not lead to a worldwide financial crisis. What was different this time was the number of junk mortgages, 25 million of them, with unpaid principal balances of over $4 trillion. Between 2005 and 2007 alone, Fannie and Freddie bought over $1 trillion in these junk mortgages. We've never seen anything like this. Here's a chart prepared by Fannie Mae that shows how fast and how soon these mortgages are failing. You can see that starting in 2004, each year has gotten worse, with more failures occurring sooner. Of course, Fannie and Freddie are not the only ones to blame. The banks, the same banks that are heavily regulated by the government, also bought and distributed these bad mortgage-backed securities. But Fannie and Freddie were the largest buyers, with a huge subsidy from government that gave them access to cheap money. In effect, they made the market go and took everyone else along for the ride. That's why all the banks that bought those mortgage-backed securities are weak, and some of them are failing. That's why they won't make loans, because they are afraid their assets will continue to decline in value and they'll become insolvent. Unwinding all this mess is going to be very painful. But if we can learn the right lessons, maybe we can make sure this never happens again. First, we have to get the government out of the business of distorting the financial system. When the government required Fannie and Freddie to make loans to people who couldn't otherwise afford to buy homes, it was distorting credit decisions. These government-created institutions should be closed down. Secondly, we need to learn that overregulation and special preferences for private corporations are not the answer. Onerous regulations on banks did not prevent the current crisis. Why would anyone think that increasing the regulatory burden is the answer? In addition, as we can see from what happened to the banks, regulation doesn't even prevent bad behavior or failures. Third, We also should worry about proposals for special government regulation of the largest financial companies. They're called systemically significant firms. This special regulation is a bad idea because it would create the perception, which certainly was true in the case of Fannie and Freddie, that government will not allow these specially regulated companies to fail. This will distort competition. It will put smaller companies at a competitive disadvantage. We will be creating many Fannies and Freddies in all parts of our financial system, the same thing that got us into this mess. Fourth, we should be very wary of agreements among governments for global regulation of banks and other financial institutions. In the 1980s, and again in this decade, developed nations all agreed to a set of rules for controlling bank risk-taking. As we can see, it was a failure. Indeed, it was these so-called Basel rules that gave banks an incentive to load up on toxic assets such as mortgage-backed securities. Notwithstanding this poor track record, the Obama administration may in fact be sympathetic to a plan for comprehensive regulation of all elements of the financial system. This new effort by governments to control all financial activity will suppress innovation and competition, cut economic growth, and increase the cost of credit. I'd like to close by posing a question. It seems clear that government distortion of the credit system through Fannie Mae and Freddie Mac caused our current problems. And it's also clear that a global system of bank regulation has failed. Why then would anyone think that even more government controls over this financial system is a good idea? I hope you'll help out by sharing this Center for Freedom and Prosperity video with others.